I will explain everything in detail. And you have to read out your material, study material. And also different books written by various authors in the field of accounting, based on the modules included in your syllabus. And,
accounting is a systematic process of identifying, measuring, recording.
You wait there.
Okay.
And I had been teaching this accounting for managers for over the last 25 years. Actually, different types of accounting: financial accounting, cost accounting, management accounting, specialized accounting, higher accounting, and some of the modules in your syllabus were taken from this accounting. So it is very difficult to suggest a very good book for you for reference. So module wise module, I will give you the name of the book you have to refer. So whatever be the book you have to refer, your study material is your base for understanding accounting. So before going to my presentation, I will introduce myself. I am working as professor in the Department of Commerce, University of Kerala, Karivattam. Can you see my PPT? Can you see my PPT?
Yes, sir.
No, sir.
Yes, sir.
It's okay. This is basically the first module of your study material. Can you see?
Yes, sir, it is visible.
It is visible. Okay, thank you. See, the first module started from introduction to accounting. Accounting is basically a business language. See, Malayalam is a language, English is a language, Hindi is a language, Tamil is a language. The language used for communication. Similarly, the business uses a particular language for communicating the business results. Business results means the outcome of a number of transactions in business. Such a business result shall be communicated to the stakeholders of business, and that language used for communication is called accounting. In simple words, accounting is a business language. So many definitions are given for accounting, but this is a common meaning of the term accounting. Accounting is a business language. But in examination, there may be a question: define accounting. Then you have to define it. According to one commonly accepted definition, one definition is commonly accepted everywhere. Accounting is the art of recording, classifying, summarizing in a significant manner And in terms of money, transactions, events which are in part of at least or financial character, and interpreting the result thereof. This is a main definition of the term accounting. I have already mentioned accounting is a language. It's a business language for communicating the business result to the stakeholders. But this is a worldwide accepted definition of accounting. Accounting is the art of recording, classifying, summarizing. What is recording? What is classifying? What is summarizing? See, a lot of transactions every day taken place in business. Every day, a lot of transactions are taking place in business field. Say, for example, sale of commodity, purchase of material, payment of wages, payment of salary, payment of stationery. So daily, every business transactions are taking place. Such business transactions are in the cash payment or in cash receipts. Maybe cash transactions, non-cash transactions. Such transactions shall be recorded properly. Then such recorded transactions are to be classified, then summarizing. And all the transactions must involve either cash inflow or cash outflow. That means, and in terms of money. And which are in part of at least of financial character and interpreting the result thereof. After a group of transactions have been taken place, there must be a result. So, whenever a transactions taking place, such transactions are to be recorded. Then a group of transactions are to be classified, summarized, and such transactions involve money elements. And finally, there will be a result of such transactions. And all these are to be communicated with a language. And that language is called accounting. So, accounting means business language. And this is a systematic process of recording, classifying, summarizing all the money transactions. And there will be an interpretation, which means there must be a result. Such a result shall be properly communicated. For that purpose, a language is Please mute your mic. Please. Then another definition, process of identifying, measuring, communicating economic information to permit informed judgments and decisions by the users of information. This is something more managerial. The first definition clearly specified, accounting is the art of recording, classifying, summarizing all the transactions which involve cash outlay or cash inflow, and that shall be properly interpreted for getting a result. Such a result shall be properly communicated. For that purpose, there is a language, and that language is called accounting. But the second definition is something different. The second definition related to more managerial aspects. The process of identification of certain transactions which involve money. There is a measurement. And finally, communicating economic information to permit informed judgments and decision by the users of information. Accounting is a language for communicating the result, or there may be a systematic process, and that particular accounting system, language system, is used by some of the stakeholders for taking rational decisions. So that is why accounting for managers. Accounting for managers. Accounting is a particular system. It is a language. And there is a result. Result must be properly communicated and properly communicated in the form of information. And such information shall be used by the stakeholders for taking rational decisions. So, accounting helps the managers for rational judgments and decisions based on the information supplied by the accounting system. So, I had explained what is the general meaning of the term accounting and what is the first definition and what is the second definition. The first definition looks into the process of accounting, method of accounting. But the second system deals with the second definition deals with the more managerial information for taking rational judgments and rational decisions by the stakeholders. See, what are the objectives and scope of accounting? And this particular question may be asked for your examination. What are the objectives of accounting? And what are the scope of accounting? The main objective to maintain a systematic record of business transactions. Every day, every hour, every minute, a large number of business transactions are taking place. So what are the objectives of accounting? We classify such a transaction, recording it, then summarizing it, interpret it, and for that purpose, to maintain a systematic record of business transaction. Different types of books of account are to be kept by the manager for dealing such transactions. So that is why the first objective to maintain a systematic record of business transactions. What are the books of accounts to be maintained in accounting? Normally, as per the principles of accounting, every businessman has to prepare ledger, journal, and trial balance. Journal, ledger, and trial balance. The transactions are firstly entered in the journal, posted or recorded in the ledger, then trial balance will be prepared later. So these are the main books of accounts to be prepared by every businessman as per the principles of accounting. So the first objective, to maintain systematic record of business transaction. Second objective, there will be a result. So when you deal with the money and cash, there may be some cash outlay, that means cash outflow. At the same time, cash inflow. There may be revenue, there may be expenditure, there may be profit, there may be loss. So every transaction will give a result. The result may be either profit or loss, surplus or deficit. So every businessman is curious to know the net result of business operation. The net result of business operation must be identified. And at the same time, whenever you are dealing with the cash payments and cash receipts, income and expenditure, there must be a result. The result may be either profit or loss. So the second objective of accounting, to ascertain profit or loss from the different business transactions that are taking place in the business field every day. Next, suppose a business organization functioning globally, it has A large number of transactions taking place every minute, every second. So such a transactions are involved cash outlay or cash receipts. Then we have to identify the result, calculate the result, whether the business concern is running at a profit or loss, and what is the financial position of that business organization. Financial position means how much assets that particular organization owned during a particular time, and how much liabilities such business organization over it to the outsiders. So what are the assets? What are the liabilities? For that purpose, we have to prepare a balance sheet. So profit and loss account and the balance sheet we will discuss later. But here, one of the main objective of every business organization when dealing with accounting to ascertain profit or loss, to determine the financial position. And next one, to provide information to various users. Accounting is a business language, I have already mentioned. So whenever we use that particular language for conveying something, such information shall be useful for the stakeholders. So to provide information to various users, the most important objective of accounting is to provide information to various interested parties or stakeholders. So managers are to manage their business organization. How to manage? They manage their business organization on the basis of the information furnished by the accounting system. There are a lot of books and accounts prepared by the manager as per the accounting principle. Such a record shall be the proper guidance for the manager to take decision. Therefore, the accounting provides information to managers for decision making in the case of uncertainty. Then to assist management, I have already mentioned, the accounting is a language in which communicate different information. Such information shall be used by the manager for taking rational decisions. Next head, scope of accounting. Scope of accounting. So there is a diagram or a picture or a model which clearly mentioned the scope of accounting. See, data creation and collection. Data means information. Information creation and collection. There is a historical way of data creation and collection. Based on such information, there is a need for prediction. So, data creation and collection, historic and predictive. Then processing methods, manual, mechanic, and electronics. So whatever be the data created and collected, by using different methods, such data shall be properly recorded. Data creation and collection, historical way and predictive way. Different methods are used, manual, mechanical, electronic, and such data or information shall be recorded. For that purpose, there are different accounting methods. All these are properly done with the accounting theory. There is certain specific theory, and based on such a theory, we create data. Data means information, and collect it in historical and predictive way. Different methods are to be used. and that shall be properly recorded. And there is data evaluation, budgetary control, performance analysis, fund flow analysis, internal auditing. We will discuss these 4 concepts later. And finally, data reporting. Data means information. Such information shall be reported and that shall be used by the stakeholders. For that purpose, the language of business, the accounting system is used. So this is a particular model developed by R.J. Bull, Accounting in Business, Butterwoods, London, in the year 1969. So this model, which clearly specifies the relevance of or the scope of accounting, and this is established by R.J. Bull. So based on this model, we can explain each and every element in the model: data creation and collection, data evaluation, analytical and interpretative, then data reporting, and there will be an accounting theory. All these are properly done by following the accounting theory. And the central purpose of accounting is to make possible the periodic matching of cost and revenue. That is very important. When we use a particular accounting method as per the theory, the central purpose is to make possible periodic matching of cost and revenue. So cost, revenue, that shall be matched. So there will be a result between these two. There are certain costs incurred when we do business. There are certain revenue generated from the business. So cost and revenue, that should be matched. But in reality, that cannot be matched. Sometimes the cost will be much higher. Revenue will be much lower. Otherwise, revenue will be much higher. Cost will be much lower. Then there will be a result. And that result shall be properly communicated. Then I have already explained the definition of accounting. Then the American Institute of Certified Public Accounts clearly defined the term accounting. I have already explained 2 definitions. Such definitions are very important. In addition to this, the American Institute of Certified Public Accounts, AICPA, defined the term accounting like this: act of recording, classifying, summarizing, significant manner in terms of money, transactions, events which are in part at least of financial character, and interpreting the result thereof. And this definition is almost similar to the definitions already we had explained. So anyway, you try to understand or try to learn any one of the definition. Then you will understand what is economic event. That is very important when you study the accounting principles. Economic events are those which are a result of a consequence of a money transaction. See, we want to construct a bridge or a building. The total estimated expenditure for the completion of a building or a bridge. So this is a consequence of a money transaction, a group of money transactions. So economic event simply means money transaction. Money transaction is otherwise called economic events. Such economic events or money transactions have to be identified, measured, recorded, and communicated. Then there will be a result, either profit or loss, either surplus or deficit. Then we have to identify the financial position of a business organization. So it is the responsibility of every manager of a business organization to understand or to prepare the financial statement which clearly indicates the profitability and financial position. So that is why how many assets the organization has to own and how much liabilities the organization has to fulfill. So assets and liability, then that has to be identified by preparing a particular statement, and that statement is called a balance sheet. See, another important equation here, owner's equity. Owner's equity. Owner's equity is one of the three vital segments of a sole proprietorship balance sheet and one of the main aspects of accounting equation. Asset is equal to liability plus owner's equity. See, I had been working as professor for over the last 10 years. I was working as professor. What are my assets? I have a land, I have car, I have jewelry with me. So many assets I have owned and operated. So whenever you calculate my asset, the worth of my asset, definitely I should have certain liabilities. When I took a loan from bank for the construction of my house, this is my liability. At the same time, I generated some cash as a salary. This is my owner's equity. So asset means what? Liability plus owner's equity. That is a very, very important accounting equation. Asset is equal to liability plus owner's equity. That is very important. Am I audible? Can you hear my voice?
Yes, sir.
Okay.
Yes, sir.
Then asset is equal to liabilities
Yes, sir.
plus owner's equity. This is a very, very important accounting equation. Suppose you are asked, what is accounting equation? Simply you can say asset is equal to liability plus owner's equity. It represents owner's investment. I have to invest some money into a particular project. So that investment is called capital. Whenever I withdraw some amount from the invested money, it is called drawings. And we will explain what is investment, what is drawings later. Anyway, the accounting equation is asset is equal to liability plus owner's equity. Then steps in accounting cycle, next section. Identifying financial transactions. Even the definition of accounting clearly mentioned identification of different financial transactions. Financial transaction means cash transaction, otherwise called economic events. Then measuring the transaction, recording it, classifying it, summarizing it, analyzing and interpreting the financial data, and finally communicating such a result. When you consider the preparation of financial statements of a company, every year the company has to prepare the financial statements, which includes profit and loss account, balance sheet, some of the schedules, as the explanation given to such a statement, and all the reports are to be prepared and presented in the annual general meeting of the shareholders of a company. That is mandatory as per the Companies Act 1956 and also the amendment in 2013. Therefore, it is a responsibility of a manager of a biggest enterprise to summarize, record, classifying, interpreting the result of all the business transaction, and that must be useful for the manager to take rational decisions under any conditions in future. So whenever a manager has to take a particular decision based on the information furnished by the accounting system, which includes the financial statements, that is trading a profit loss account and balance sheet, and interpreting the result of such statement, that is a useful communication, useful information for the manager to take decision under the conditions of uncertainty in future. Bookkeeping versus accounting. So there is a question whether bookkeeping is a part of accounting or accounting is a part of bookkeeping. So what is bookkeeping? It is a component of accounting that involves process of identifying the financial transaction, measuring, recording, classifying those transactions that has occurred in the course of business. So whenever a transaction is taking place, that shall be recorded, summarized, and classifying and interpreted. This is simply called bookkeeping. But accounting is the biggest thing, which includes bookkeeping. Bookkeeping is one of the elements of accounting. Accounting begins where bookkeeping ends. Transactions taking place, we record it, summarize it, classifying it, interpret it, then there will be a result. This is bookkeeping. Bookkeeping ends whenever bookkeeping ends. The accounting system starts its functions, which include summarizing, interpreting, and communicating the financial data to users of financial statements. There must be a result of bookkeeping that is called that is a function of accounting. Then accountancy. What is accountancy? Accountancy refers to systematic knowledge of the accounting principles and techniques. How to prepare different books of accounts. How to analyze, how to interpret the business result. This is a part of accounting. And bookkeeping and accounting come under accountancy. So accountancy involves bookkeeping and accounting. Accountancy has two elements, bookkeeping and accounting. So there is a possible question, distinguish between bookkeeping, accounting, and accountancy. So what is the difference between accounting and accountancy? And this is the expected question for your examination. Next one, system of accounting. This is very, very important. Double entry system. So as per the principles of accounting, every transaction has two aspects. Maybe receiving aspects or payment aspect or giving aspect. The item which we owned, the item which we owned and owed. So the accounting principle clearly mentioned every transaction has two aspects. One is debit, another credit. These two aspects are equally important, equally recorded in the books of account. For every debit, there is an equal and opposite credit. And this is called a double entry system. The second system is single entry system. we have to consider only one aspect, either debit or credit. Say, for example, payment of salary. This is a cash transaction. This is an economic event. Whenever we pay salary, there is cash outflow. Cash goes to somebody. This is a giving aspect. At the same time, for what purpose we pay the amount? Payment of salary. Salary is another aspect, cash is another aspect. Two aspects involved in this particular transaction. One is cash, another salary. Payment of cash in the form of salary. But in the case of single entry system, there is only one aspect. Maybe either debit or credit. So double entry and single entry, these two systems are very important in accounting. When we deal with the double entry system, we have to identify the two aspects involved in every transaction, every financial transaction, every economic event. Two aspects must be there. One is cash, another salary, payment of salary. One is cash, another salary. But single entry system, the books are maintained by considering only one event, one aspect, either debit or credit shall be recorded in the books of account. That is called a single entry system. So there is a question, very important question, distinguish between double entry and a single entry. See, double entry system. Double entry system is based on dual aspect principle, debit and credit. This system of accounting recognizes and records both aspects. Minimum two accounts are involved. For example, cash and salary. Payment of wages, cash and wages. Purchase of furniture, furniture and cash. That means the accounting equation should not be violated. The double entry system, we have an accounting equation. Asset is equal to equity plus liability. That particular equation has to be followed in double entry system. And such equation is violated in single entry system, which means under this system, both aspects are not recorded. Either only one aspect is recorded or both of the aspects are not recorded. So that is the difference between single entry and double entry. I had already given you one example, payment of salary. There is a cash outflow. Cash goes to somebody in the form of salary. Two aspects. Cash is the first aspect, salary is another aspect. These two aspects are properly recorded. Then we can say that this is a double entry system. If you do not record these two transactions, or if you record either one of the elements, this is called a single entry. So double entry principle clearly follows the two aspects of every business transaction, every economic event, every cash transactions. But such dual aspects cannot be seen in single entry system. So that's the difference between single entry and double entry. That is very important for your examination. Advantages of double entry system. When we follow two aspects equally, debit and credit, what are they counting? What are the advantages? One is scientific system. If we record both the aspects equally, this is a scientific system. A complete record of transaction. A transaction is completed only when we identify both the aspects involved in the cash transaction. Payment of salary. Salary is one aspect. Cash is another aspect. Purchase of furniture. Furniture is one aspect and cash is another aspect. And arithmetical accuracy can be ensured by following double entry system. That means for every debit there is equal and opposite credit, which means arithmetical accuracy can be ensured. When we see one aspect of one transaction in the books of account, there must be another aspect lies somewhere in the book of account. So two aspects are to be considered and recorded in the books of accounts. So arithmetical accuracy can be ensured. Determination of profit or loss, or identify the financial position with the double entry principles. Helpful in decision making, because whenever we verify a particular transaction which involve two transactions with two elements, either debit or credit, we can easily taking relevant business decisions. So helpful in business decision making, which means the information furnished by the double entry system is useful for the manager to take rational decision. Next, we had applications of accounting. Main applications of accounting: provide information about the financial performance. See, sugar industry in Kerala, 3 sugar manufacturing units once successfully functioning in our state. Such as 3 sugar manufacturing units are becoming sick now. There was no production in any sugar manufacturing units in Kerala. So when we verify their financial performance by analyzing the annual reports, which includes trading of profit loss account and balance sheet and some of the schedules prepared as per the provisions of the Indian Companies Act 1956, definitely we can identify the financial performance of such organization. The financial performance of any organization can be evaluated by considering the financial statements, which includes the trading and profit loss account and balance sheet, prepared strictly on the basis of double entry principle, and provide assistance to management. Management needs information for taking decision. The quantified information is given by the financial statement. The accounting system clearly gives the quantified data, the quantified information, and that shall be very essential for taking rational decisions. So provide assistance to management. Facilitates comparative study, comparison. We can compare the result of an organization with other organization of similar type. We can compare the result of one period with another period of the same institution. So comparison is possible only when we have to identify and consider the two aspects of every economic transaction, and helps in settlement of tax liability. Tax is paid on the basis of the profit generated by the organization. Whenever an organization has profit, as per the result of the accounting system, the organization has to pay the tax. So accounting information clearly indicates whether such organization is running at a profit or loss. So accounting helps the settlement of tax liability. Helpful in raising loan. Suppose an organization raises loan from financial institution, definitely such organization has to prepare and submit the financial records to the banks. So helpful in raising loan, and helpful in decision making, and substitute of human memory. Whenever we prepare the financial result of an organization by following accounting concepts and theory principles, definitely such records are the substitute of a human memory, and helps in evaluation of business. An organization can be valued, the business can be valued. Information is why. Then what are the limitations? done on his values are considered, and ignore the effect of price level changes. Inflation cannot be considered by the accounting system. Ignore the qualitative information. Some of the quantitative informations are relevant for decision making. At the same time, the accounting system eliminate qualitative information. And finally, some of the accounting information are not proper and affected by window dressing. Say, for example, Manorama, MRF, are you ready to take information from Manorama? Their annual sales, their annual profit, annual expenditure. You cannot access such data from Manorama. So that is why there is window dressing. So these are the limitations of accounting. Then comes to qualitative characteristics of accounting information. And within the next couple of minutes, I will come back.
We are unable to listen anything, sir.
Okay, we will start again. So next, qualitative characteristics of accounting information. Accounting information is a reliable information. Say, for example, the total revenue expenditure of government of Kerala, this much crores. Total GST collected by the state, this much crore. So such a quantified information is a reliable information. That is the first characteristic of accounting. Relevance. Relevant information shall be given by the accounting in a quantified form. Understandability. When we read out a particular books of account, we must understand everything. I have already mentioned there is a comparability. Compare the result of one organization with another organization. Compare the result of one period with another period of the same organization. So next, accounting as an information system. In all the definitions of accounting, we can say that this is an information, quantified result of business events or economic events, and there will be inputs, that means raw data, process it, and there will be output. So here the information means the input, raw data, which are the transactions, process it, that means summarizing and recording and classifying it, and finally there will be an output in the form of reports and information, which include the preparation of trading and profit account and balance sheet, otherwise called financial statements. So another important thing, there are several groups of people who have a stake in the business organization: managers, shareholders, creditors, employees, customers, banks, and public. So these are the stakeholders of business organization. And the business results are to be properly communicated to such stakeholders for the existence of the business organization. And there will be an accounting system and its relevance. Shareholders and investors, creditors, then employees, government, management, consumers and others, that's the public. These are the stakeholders of every business organization functioning nationally or internationally. And accounting is a language properly used by the business organization to communicate its results. And nature of accounting function is a service function. The service function performed by the organization to communicate its results. Emerging role of accounting. This is very important. Stewardship accounting. This type of accounting originated in the 15th century. That means the business lions appointed stewards to manage their property. Suppose hello. Hariomara. Okay. So stewardship accounting is the first phase of accounting, or accounting emerges in the form of stewardship accounting. In this type of accounting, some of the wealthy people employed stewards to manage their property. Wealthy people employed somebody else to manage their property. So in order to manage the biggest properties, large amount of properties, they will follow the accounting principle. That is why this is the oldest form of accounting, stewardship accounting. And next phase of accounting is financial accounting. Almost all the transactions are in economic character, economic events, financial character, financial events, cash transactions. So when we deal with the money, this is a financial transactions. So financial accounting is an accounting system. The second phase of accounting, which clearly recorded, classified and summarizing the financial transactions, cash transactions, economic transactions, which clearly indicate the result of the business organization. Maybe total revenue, total expenditure, total profit, total loss, then assets, liability. Asset is equal to equity plus liability. So all these are clearly mentioned in the financial accounting system. Next one, cost accounting. So what are the limitations of financial accounting? Because the cost accounting emerges in order to overcome the limitations of drawbacks of financial accounting. So sometimes you can expect a question for your examination, distinguish between cost accounting and financial accounting. See, cost accounting, we record the cost of a particular product, cost of manufacture of a particular product. But such a cost of manufacture of a particular product will not be given by the financial accounting, because the financial accounting deals with the money transactions. Financial accounting deals with the economic events. In the financial accounting, what is the cash inflow? What is the cash outflow? What is the net result of all the cash transaction? Maybe profit or loss, surplus or deficit. That shall be clearly presented by the financial accounting. But in cost accounting, we can identify the cost of the product, that means cost of the manufacturing of a product. Whenever a product is manufactured and distributed in the market, what is the cost? What is the cost of that product? When we add certain amount as profit to cost, we will get the selling price. So selling price is equal to cost plus profit. And what is cost? What is the amount of cost for the produce? What is the cost of expenditure? What is the cost incurred for producing a particular product? That shall be clearly mentioned by the cost accounting system. So what is the difference between financial accounting and cost accounting? Financial accounting deals with cash transactions or economic events, but cost accounting deals with what is the cost of a particular product when it is manufactured. Then the fourth phase of accounting is management accounting. Management accounting draws information from financial accounting and cost accounting. Financial accounting deals with the cash transactions. What is the cash surplus and what is the cash deficit? What is the profit and what is the loss of an organization? What are the cash transactions, economic transactions taking place for a particular period? And cost accounting deals with what is the cost of manufacture of a particular product. What is the cost of material? What is the cost of labor? What is the cost of overhead? What is the direct expenditure? What is the indirect expenditure incurred for producing a particular product? That shall be clearly given by cost accounting. And management accounting takes information from financial accounting and cost accounting, and such information shall be refined, processed by this particular system, management accounting system, and that shall be supplied to the business manager for taking rational decision. The business manager has to take decision based on the quantified information given by the financial accounting and the cost accounting. So that is why the management accounting is the fourth phase of accounting, which clearly takes some information, quantified information from the financial accounting system, from the cost accounting system, and supplied it to the manager of an organization for taking rational decision. So the scope of management accounting is very simple. The management accounting takes information, quantified information from financial accounting and cost accounting and supplies such information to the manager for taking rational decisions. Next is social responsibility accounting. Every organization has to take some social responsibility to business, social responsibility to stakeholders. Suppose I am the manager of an organization. I have to consider employees. I have to consider consumers. Definitely, the employees, consumers, bankers, creditors, and shareholders, their aims and objectives are to be fulfilled by the manager. So every organization has certain social responsibility to fulfill. And how such a social responsibility is fulfilled by the business organization or the business manager, and such a function is quantified, so that is called social responsibility accounting. How far the organization fulfill its objectives and responsibility towards the third parties or the external and internal stakeholders. And this is the relevance of social responsibility accounting. Next, human resource accounting. Human resource is a vital resource of an organization. Suppose in an organization, 10 managers are efficient. They are working for over the last 10 years. They are highly qualified. So they are the vital resources of an organization. Human resources are the vital resource of an organization. This is a scarce resources also. Then how such resources are to be obtained and used by the organization for its well-being. Then there is an accounting system which clearly indicates what are the sources of the intellectual capital and how such intellectual resources, human resources, are effectively used by the organization. And this accounting system is called human resource accounting. Inflation accounting, price level changes based on inflation. So there is a change in the price level due to inflation. Then how far the inflation affects the business organization. So this is called inflation accounting. Next, accounting concept. This is very, very important for examination. What are accounting concepts? So there are certain theories and principles of accounting which clearly govern the preparation of books of accounts. Business entity concept. See, as per the provisions of the Indian Companies Act 1956 and also its amendment, business is a separate entity which is entirely different from managers, employees, and stakeholders. Suppose you are appointed as the manager of an organization. For over the last 2 years, the business is running at a loss. Who will suffer? Whether the management. പറ ഇല്ല നേരത്തെ വിളിച്ചതാ. ഞാൻ ഇപ്പൊ തിരുവനന്തപുരത്താ. ഞാൻ തിരിച്ചു വിളിക്കാം. ശരി. So the manager and business organization, there are two entities, separate entities. So for example, you are appointed as the manager of an organization. And for the last 2 years, the firm is running at a loss. Who will suffer? Whether the manager has to suffer or the organization has to suffer. Here the organization has to suffer. Similarly, for over the last 5 years, the organization has huge amount of profit. Who will get the benefits of such a profit? Only the shareholders, the owners. So business is a separate entity which has no relation with its managers, employees, bankers, and other stakeholders. It has separate entity, and that is a business entity concept. Next concept is money measurement concept. I have already mentioned a lot of cash transactions are taking place. A lot of economic transactions are taking place. So there is a cash inflow, there is a cash outflow. There is income generated, revenue generated, expenditure incurred. So the accounting mainly concentrated on the money transaction, money measurement. This is the second theory, second concept of accounting. Continuity. Once a business organization is established, it is assumed that it can continue for a longer period. The retirement, the death of the stakeholders, the managers, the shareholders will not affect the functioning of an organization. So as per the provisions of the Indian Companies Act 1956, once a company is formed, it continues to exist for a longer period. The death, the retirement, and the dissolution, the retirement, the death of the stakeholders or employees will not affect the business organization, will not affect the functioning of the business organization. So that is a continuity concept. Cost concept, as per the provisions of the cost accounting principles, definitely we have to identify the cost of acquisition of land, cost of building, cost of machine, and cost of property right, cost of the production of a particular component or product. So this is another form of accounting, cost accounting, which clearly indicate the cost incurred for producing a particular product. So cost incurred shall be recorded, summarized, and classified. So the cost sheet which clearly indicate what is the cost of a product, what is the total cost of a product for its manufacture. Accrual concept. In accounting, we will consider the accrual. Say for example, your salary is 1 lakh. During a particular month, you have given daily allowance, DA, 10%. DA declared by the government, 10%. So your present salary is 1 lakh. Due to some technical reasons, The DA will not be distributed to the employees. But in the next month's salary, you clearly indicate your accrued DA is 10%. That means whenever an income is accrued, the expenditure is accrued, that shall also be included in the current accounting period. The accounting period, when we consider some of the income to be generated in future, but that can be accrued during the accounting year, it shall be included. So this is accrual concept. Conservatism, this is very important. The concept of conservatism, also known as the concept of prudence, is often stated as anticipate no profit, provide for all possible losses. This is very important. We will not anticipate the profit. At the same time, we have to be very careful for incurring losses. Suppose your organization is functioning for over the last 10 years. First year profit, second year profit, third year profit. But in the fifth year, you expect a profit normally, but you will not expect it. You are always provided for incurring losses. You will be cautious for incurring losses. So that is why this is called conservatism, not optimism, but conservatism. Anticipate no profit, but provide for all possible losses. All the precautions are to be made for all possible losses. Materiality concept. We will consider certain information useful for the organization, and this concept holds that item of small significance. So there are certain significant elements in the business organization, maybe big or small, but we always consider small elements, certain small elements that are very, very important in business. So that is called materiality concept. Consistency. Our organization is always consistent. Our organization is always reliable. We have a concrete base for our organization. This is our belief. Our organization is consistent. Periodicity concept. Accounts are prepared for a particular period, maybe financial year or calendar year. The accounting period may be financial year or current year. Financial year means April 1 to 31st March next year. Calendar year means January 1 to 31st December. So there will be an accounting period for which we have to prepare the accounts. Accounting standards. There is a standard for the preparation of accounting information. We have certain books of accounts to be prepared in the accounting system. So there must be certain accounting standard for which we have to complete our books of accounts. Changing nature of generally accepted accounting principles, GAAP, that is very important. In India, all the provisions of the accounting system are managed by Institute of Chartered Accountants of India, ICAI, and also American Institute of Certified Public Accounts, AICPA. So the American Institute of Certified Public Accountants and Institute of Chartered Accountants of India, ICAI, these two bodies clearly specified certain principles for the preparation of accounts of an organization. The accounting system, the accounting concept, the accounting conventions, all these are formulated by these two accounting bodies, American Institute of Certified Public Accounts, AICPA, and Institute of Chartered Accountants of India, ICAI. So these two bodies clearly given certain principles, certain methods, certain conventions, certain theories for the preparation of the books of accounts. And such theories and principles, concepts and conventions are recognized by the academic research, regulatory and tax laws of the government, Companies Act 1956, Income Tax Act 1961, and there are such principles already accepted by SEBI, Securities Board of Exchange of India. So these are the agencies which clearly specified certain methods, principles, rules, and regulations for the preparation of books of accounts, and such books of accounts are accepted by the companies under 1956 Companies Act, Income Tax Act 1961, and also the SEBI, Securities Board of India. So the first module is over, and if you have any doubt, please call me. Please, if you have any doubt, please ask me. Yes. Am I audible?
Yes, sir.
Yes, sir.
Yes. Okay, tell me.
Yes, sir.
Aishwarya KG.
Yes, sir.
Rajani, ask. You have any doubt, I will clear you.
Sir, clear, sir.
Okay. Okay, so the next class, tomorrow, day after tomorrow, I have a class, but I will not take it because I have some personal assignments. So, when will the next class, as per your timetable? I think 3rd May, I have a class as per the timetable. Am I correct? Aishwarya KG. Hello?
2nd May, sir.
2nd May, sir.
Second May.
Yes, 2nd May.
It is
4 to
impossible.
6.
Next class after 2nd May.
17th.
17th May.
Yes, sir.
17th.
Yes, sir.
Okay, then
17th. Then
17
20th
after
May.
17?
20th May.
20th May. Appo 2nd May, 17th May. 2nd May and 17th May, I have some personal assignment. So 20th May, it is okay. Huh?
Okay.
20th May, it's
20th
okay.
and 21st also your class.
20th and
21st May also it's scheduled at your class.
okay. 20th and 21st, I will be available. So for the 2nd May and the 17th May, you direct the coordinator, you contact the coordinator and arrange some other days for me. Okay.
Okay,
Okay.
sir.
Okay, sir.
I will also
Okay,
inform
sir.
such.
Sir, I think we
inform
cannot contact them. I think you might
Okay,
have
okay, okay.
report them so that
I will
they can
contact
arrange.
them and arrange some alternative
Oh,
days.
okay.
Okay. So we will meet on 20th. Okay. Thank you.
Okay,
Thank you very
thank you,
much.
sir. Thank you.
Thank you, sir.
Thank you, sir.
Thank you.
Thank you, sir.